A 50% stock market haircut and a 30% real estate crash are coming.
Expert Michael Pento joins our panel of analysts to warn about a historic triumvirate of asset bubbles.
We distill the signals from these historic vertical rallies and the critical levels you must watch right now.
See why some experts believe interest rates will eventually reverse course as growth stays weak.
This lockout rally has been one for the books. It seems like, any move in the market, we're always like, that's historic, that's historic. But this truly is.
Vertical, absolutely vertical, right? So very impressive stuff on this ES futures chart. Let's go back to the 4-hour timescale. And really, all we've got to do is start saying, okay, you're long from down here.
AMD plummets 8% in the pre-market trading despite beating expectations.
SpaceX down about 12% after AI spending surges, and it rattles investors.
Eli Lilly tops quarterly estimates, raising outlook as Zepbound and Mounjaro sales surge.
That previous all-time high, 7740, is critical.
I would like to see Meta reject 600, the 50 SMA, come on down, and then Brigade Bolt underneath the previous day's low. Where is the spot I can put on the risk with tight stops, manage my position, and know if I'm wrong, it's under this level, and I can step aside, and I'm not going to lose much, right?
Jeff Snider is looking at the 30-year long bond yield, which hit its highest level since 2007 and has stayed above 5%.
People are asking if this represents a significant regime change in the market, but Jeff is skeptical. Jeff's main point is that we need to identify if this is a true state change or just the market reacting to Federal Reserve policy risk.
So the nominal level isn't the whole story?
Exactly. He argues that looking at the curve shape and other signals reveals whether the market actually sees inflation or growth.
In 2008, the central bank was forecasting no recession and raising rates because of oil prices, missing the deflationary risks entirely.
Jeff notes the market had to respect the Fed's potential craziness even while the underlying economy was failing.
Back in 2018, everyone was a bond bear when the 10-year hit a 7-year high. They thought rates had nowhere to go but up.
But the market turned around almost immediately?
Yes, within 7 months, it hit a record low because the fundamental signals, like swap spreads, were already pricing a turnaround.
The TIPS market and swap spreads are not signaling inflation or a roaring economy. Instead, they show that the market believes the Fed is making a mistake in 2026.
Jeff predicts that interest rates do not have nowhere to go but up. Instead, he expects them to eventually come back down as growth stays weak.
The market is already pricing in the fact that any rate hikes will not stay up for very long.
So the Fed is just repeating the mistakes of the past?
Jeff is increasingly certain that if they raise short-term rates now, they will be forced to reverse course quickly because they are misreading the risks.
The message is clear. Break through the noise of nominal yields to see the fundamental signals underneath.
The fundamentals have not changed, and the market is telling us that the Fed is doing the wrong thing at the wrong time.
Michael Pento is sounding a major alarm about the state of the economy.
He believes we are seeing a record-breaking bubble in stocks, credit, and real estate all at once.
He calls it a triumvirate of bubbles and says the current disconnect from reality is unprecedented.
What is the actual pin that pops these bubbles?
According to Pento, it is higher borrowing costs. He says they are the natural enemy of record asset crisis.
So as long as yields stay elevated, the pressure on the system just keeps building.
Pento is looking at a 30% drop in real estate just to reach normal levels.
He says prices must fall until the monthly payment fits the average paycheck.
For the stock market, he is even more bearish.
He mentions a 50% haircut just to bring things back to historical norms.
He is also warning about a lost decade for investors.
Pento notes that after the Great Depression, the average annual return for 20 years was just 0.6%.
Pento is using the D word here. He is not just talking about a recession.
Correct. He believes this cycle ends in a deflationary depression because the debt levels are so high.
If the system breaks, how does the government respond?
Pento predicts another massive wave of money printing that will lead to hyper-stagflation like we have never seen before.
What is the takeaway for investors right now?
Pento suggests moving to active management to protect wealth. He is currently keeping his portfolio neutral in what he calls Sector 3.
And that's the full rundown for today. Want the final verdict, where these experts agree and where they clash head-to-head? It's in the video linked below.
Give this a like if it saved you time, and subscribe so you don't miss tomorrow's breakdown.